Away from politics, the Reserve Bank of India today released the second Financial Stability Report. Now, this report is written by a group comprising the RBI, SEBI and Finance Ministry officials, and it talks about being worried about global risks. It's optimistic of improved Indian macros and fearful of high corporate leverage and almost paranoid about the heightened stress in PSU banks. Ritu, Singh and Latha Venkatesh get you the highlights of the report.
Risks to the banking sector have increased since the last stability report in June. That is the verdict from the second biannual Financial Stability Report of the RBI. Worsening asset quality and sluggish profitability are causing the stress. RBI also notes the worsening balance sheets of large borrowers, that is, borrowers with loans of over 500 crore rupees. RBI says gross NPAs of these large borrowers from public sector banks went up from 6.1% in March to 8.1% in September. The silver lining is the improving Indian macros with lower twin deficits and reined-in inflation.
The only issue is that if global risks go up, then our ability to withstand the aftershocks really depends on how well we manage our domestic economy. So in a sense, I think it puts a lot more responsibility on our policymakers than if we had a buoyant global economy.
The report points to the fact that although corporate profitability has improved from March to September, the share of the top 100 leveraged borrowers has increased from 17.8 to 27.6%. In fact, the large corporate borrowers are turning out to be the biggest threat. Their share in the total bank NPAs have gone up to 87.4% in September. Banks, especially the public sector ones, are showing the strain. Gross NPAs of all banks stood at 5.1% in September versus 4.6% in March. Stressed advances, which includes gross NPAs and restructured advances, also rose to 11.3%. Stressed assets of state-run banks stood at 14.1%.
Banks will need to look at haircuts of between 15 and 25% on a case-by-case basis. And we're talking of credits that are still not yet reported as NPLs. So apart from rising concentration and the growing NPL that the RBI report has pointed out, there's also the below-the-radar challenge of assets that are getting restructured, refinanced for the 525, but in our view are not adequately provisioned because of the belief of their fundamental viability, which I think is correct, but financially they would need some support, some principal write-down to be financially viable. I think they're operationally viable, but not financially viable.
The RBI's baseline scenario is that gross NPAs will rise to 5.4% by September 2016 from 5.1% this year. Under a severe stress scenario, assuming the macros deteriorate further, gross NPAs could rise to as high as 6.9% by March 2017. The FSR makes a strong plea for relooking the capital allocation and dividend policies of PSU banks, so that the dividend of strong banks is not used to capitalize the poor ones. It also argues that public sector banks need to be run on commercial principles and that utilities like discoms must charge their users correctly. Finally, the report pleads that financial inclusion must not be pushed beyond a point as it may have negative costs to the system. In Mumbai with Latha Venkatesh, Ritu, Singh.